Everyone thinks the 2008 financial crisis was the first time banks nearly destroyed the world economy. They are wrong. September 18, 1873, New York City. The morning opened like any other on Wall Street. Clerks sorted papers. Messengers moved between offices. By noon, the city's financial district had begun to collapse. Cooke Company, one of the largest investment banks in America, locked its doors. The firm had financed the Union during the Civil War. Presidents knew Cooke's name. Now he was bankrupt. What nobody on that morning knew yet, this wasn't a local crisis. It was the beginning of a 5-year depression that would reach Europe, Australia, and South America. Unemployment in America would eventually hit 14%. Families lost homes. Suicides spiked. The mechanism of collapse was simple, but the chain of events that built it took years. Start in 1869. The Union Pacific Railroad was completed. It connected the Atlantic to the Pacific. The engineering was real. The triumph was real. But the investment boom it triggered was built on speculation, not logic. Banks and wealthy individuals poured money into railroad projects. Hundreds of them. Not all of them made sense. Some lines ran through territory with almost no population to carry. Investors didn't care. They assumed railroad stocks could only go up. The Northern Pacific Railroad was the most ambitious. It would run from Minnesota to the Pacific Northwest. The company needed enormous capital. They borrowed heavily. Investors believed in the vision. The company kept building, kept borrowing. But there was a second pressure building in Europe. Germany had just won the Franco-Prussian War in 1871. The French government paid Germany a massive indemnity. Germany took that gold and reformed its currency. They moved toward the gold standard, pulling gold out of international circulation. This sounds technical. It wasn't. What it meant in practice, less gold flowed into American banks. Credit tightened. Money became harder to borrow. The railroads that had been financing expansion with easy credit now faced a wall. In the spring of 1873, the first railroad defaults appeared. Not catastrophic ones, but they were real. Investors began to ask questions they should have asked years earlier. Were these railroads actually profitable, or were they just borrowing money to pay dividends on the stock? The answer was the second. The railroads were Ponzi schemes before Ponzi had a name. They paid old investors with money from new ones. They reported profits that didn't exist. The men running them weren't stupid. They were corrupt. By August 1873, the panic had begun. Investors wanted their money back. Banks that had loaned heavily on railroad securities couldn't meet withdrawals. The New York Stock Exchange suspended trading for 10 days. That had never happened before. Cooke's failure came in mid-September. He'd bet the bank on Northern Pacific. When Northern Pacific couldn't borrow anymore, Cooke's firm collapsed. The shock rippled outward. Other banks failed. Credit markets froze entirely. What the panicked investors didn't realize in those first weeks, this wasn't going to be a quick correction. The damage was structural. Too much capital had been wasted on railroads that would never be profitable. Too much credit had been extended on lies. By October, the crisis had crossed the Atlantic. British banks had invested heavily in American railroads. When those securities became worthless, British credit markets tightened. Austrian and German banks followed. The contagion spread. The Depression lasted until 1879. 6 years of contraction. Unemployment in America stayed above 10% for most of that period. Wages fell. Farm prices collapsed. Factories closed. Entire towns built on railroad promises were abandoned. The investigation that followed was thorough but toothless. Congress held hearings. Journalists documented the fraud. Everyone agreed the railroad industry had lied about profits, hidden debts, and paid dividends from borrowed money. But the men who did it faced almost no consequences. Cooke, despite his failure, remained a wealthy man. He retired to Pennsylvania. He died in 1905, respected and comfortable. Most of the railroad barons survived the crash with fortunes intact. The workers and small investors lost everything. The Panic of 1873 taught one lesson: that markets would spend the next 135 years relearning. Leverage and fraud move faster than regulation. The railroad bubble was obvious to anyone paying attention, but attention was expensive. Greed was cheap. The mechanisms changed. The scale expanded, but the pattern held. Every major crash since has followed the same architecture: easy credit, speculative asset bubbles, false accounting, and a collapse that the people in charge never quite saw coming, or claimed not to. Subscribe for the next financial catastrophe. They follow patterns you can actually see coming.